Hello and welcome to another Smaulgld live stream. Today is the 26th of December 2019 and tonight's topic is there is your gold and silver Santa Claus rally. Ho ho ho. This is something that we anticipated back in November when we asked if the gold and silver rally of 2019 was over, and the idea back then was that pretty much the year had been cashed out by traders who had made their money, and traders had basically readjusted their positions either to show that they had gold in their portfolio at the year end or they had sold it to lock in the profit. However, the fundamentals for why gold rose in 2019 and why silver followed along are still intact, and in fact they're more intact now and more entrenched than they were at the beginning of the year. And I'm going to show you some charts that I used a couple of years back to show how the Federal Reserve manages the dollar. There was all this talk, and still is, the dollar is going to collapse and so on. And it's based on two things: what the Fed does, the money printing, and then what the U.S. Congress does, which is just spending the money. Printed the money by the Fed and then lend it out to foreigners and then just spend it at home recklessly. I get all that. However, it's all a game, and I'm going to explain why the gold price rose this year and probably will rise next year, and why silver will follow along, based on a review of interest rates. It's not just interest rates that drive the dollar and drive gold and silver and the stock market, but it's also the forward guidance that the Fed gives that drives the gold market, the silver market, and the stock market. And they're very clever in how they do it. So let's go back to 2009 and take a look at the chart of where the dollar index was. The dollar index was pretty much heading down, and that's when you had the entire talk about end of dollar hegemony all launched again, because not only did Congress approve a multi-billion, hundred billions of dollars worth of bailout money, but the Fed went into full QE. They started printing the money and buying treasuries and bailing out banks, buying their mortgage-backed securities. And let's take a look now at those charts, because when you see the charts, you can see how the dollar index reacted. And then we're going to show you how gold and silver reacted. All right, so the first chart I want to show you is the early days of QE. So when you go there, you'll see that the dollar was plodding along, but it really took a beating when, and it makes sense, the Fed decided it was going to do QE. Okay, so if you look at the far left, you see in 2006, the dollar index was pretty strong. This is at the middle of the housing bubble. People are feeling confident. The dollar is strong. But cracks began to appear. The Lehman moment was still a year and a half away. But there were people that were paying attention, foreigners paying attention. The dollar was selling off going into the financial crisis. Now, interestingly enough, when the financial crisis hit, the immediate reaction amongst traders, which makes no sense, but in retrospect maybe it does, was to sell everything and gain liquidity. Sell stocks or whatever they had. They may have old debts. So the dollar immediately bounced during the financial crisis. That was the safe haven. And of course, as was gold, and to a lesser extent, silver. But even gold, silver, and palladium and platinum at the first couple of months of the financial crisis, when it actually hit in late 2008, they sold off too. Why? People were selling them to get dollars. Now, the physical market, those you may remember, however, was different. The physical market was very tight. People may have sold their paper gold and silver assets in order to raise dollars, but there was a rush to get the physical gold and silver, and premiums on silver eagles especially were nearly 100%. But in any event, you can see that the dollar index rose in 2008 at the end of the financial crisis as a result of the financial crisis all the way up to 90. And then the Fed launched at the end of 2008, early 2009, QE1. And that drove the dollar down because it was disconcerting to people who were holding dollars, people who were holding treasuries, that the Fed could just print additional money and buy treasuries. It was, in a sense, an obvious debasement to anyone who was paying attention. Obviously, financial markets are people who pay attention. And as a result of that QE, the dollar started to take a hit. And you can see it went all the way down to the 74. Now, the dollar index is essentially the euro and a couple other currencies based against the dollar, including the Swedish krona, Japanese yen. It's mostly about 56-60% euro. And you can see by the end of QE1, the dollar index was very low, and they stopped it. They just cut it off, and then they started it again. And then you can see the dollar index fall and then rise when they start talking about stopping it again. And this fits and starts, like my cough there, is essentially what prevented the dollar from collapsing. As soon as the dollar index looked like it was going to fall through a critical point, they would stop it and let the dollar index rise again, and then they'd launch the next one. Now, during that time period, you can see the dollar index fluctuated wildly, and it got to the point by QE3 that, in my mind, that was the end. And I think a lot of people thought that. Look, they did QE1, and then they pulled off, and they pulled back from the abyss. They allowed the dollar to regain its traction. They allowed people to think that everything was fine, and then they said, nah, we got to do QE2. Then they did QE2, and what happened? Things weren't fine. But people got concerned that they were doing more QE2, so they stopped. Dollar index recovered, and then they said, we're not there yet. We got to do QE3, and this QE3 is going to be the biggest and baddest one we've ever done. And I thought at that point, that's it. They're just going to destroy the dollar, and it's going to be game over, as everyone was saying, game changer. And then a funny thing happened. That didn't happen. In fact, that was in 2012, and gold and silver were still, especially gold, near all-time highs that they had achieved earlier in 2011. It'd fallen back a bit, but you would have thought they fell back a bit, but by 2012, when they announced QE3, that they were then going to take off again. And it was really going to blow through 2,000 gold, and silver was going to go back past $50. That didn't happen. Not only did that happen, around the time they announced QE2, they still had zero interest rates at the time. That's when they had that meeting with Obama and the Treasury secretaries, and the next thing you know, boom, everything goes down. And pretty much stayed down until 2016 on a downward trajectory. But look at the dollar index. The dollar index, you would have thought QE3 would have sent it over the top and the dollar index would have fallen through the floor. But what happened when the United States, when the Fed ended QE3 at the end of 2013? You could see where the dollar index is pretty much stabilized at 80. And you would have thought it would have been lower, since it was the third QE, but that's not what happened. As soon as they stopped QE, Japan started a new one. And you could see that right there at the end of 2013. Look how the dollar index takes off. And the reason that the dollar index didn't fall during the entire massive QE3 between September 2012 and the end of 2013, almost the entire time since the beginning they launched QE3, they're always talking about tapering it and eventually normalizing rates, raising rates, and all that. It was all just talk because they didn't raise interest rates until December 2015, and they only raised them once. So it took 2 years after the end of QE3 for the Fed to actually raise interest rates. But because they talked about it for 2 years, that kept a cap on the price of gold, and that pushed the dollar higher. You can see the dollar index skyrockets from the end of QE3 because now not only the forward guidance is saying we're going to raise rates, they've actually stopped doing QE3 at the end of 2013. And Japan started, China was in full effect, and then look what happens in end of 2014, early 15. ECB starts QE. They had never done QE before. Now theirs is larger than ever, and the interest rates, the dollar index continued to rise, and gold continued to fall, silver continued to fall. And by the end of 2015, gold and silver were well beaten down, and the dollar index was sky high. And you had Japan printing and ECB printing, and you would think, well, maybe the Fed has stopped printing, but the debt situation is still there for the United States. They haven't solved the debt issuances, the massive debt, the unfunded liabilities. And you've got the ECB printing, you got Japan printing, you got China printing, you got the Bank of England printing, all doing QE, all spending. But yet, that was actually underpinning the dollar strength. Why? I just mentioned it because China, ECB, Bank of England, Japan, all those countries were now pushing forward with QE while the Fed had stopped QE. Not only had the Fed stopped QE, the Fed had never gone to negative interest rates, and the Fed was now talking about raising interest rates while the others were lowering interest rates. So that drove the dollar higher. That also kept the cap on gold, at least in dollar terms. But now a curious thing has happened. Since 2016, the Fed has raised rates, and that did keep the dollar index. Let's take a look at the dollar index now since 2015-16. You can see it's somewhat stabilized, and it actually continued to rise all through 2016 because the Fed actually then pulled the trigger again in 2016 in December with another interest rate hike. So they raised in 2015 once, 2016 once, and then in 2017 they actually pulled off a couple of more interest rate hikes, and they did some in 2018. And the understanding was that they were going to continue through 2019 to raise interest rates. But here's what happened. In 2019, the Fed reversed course, and this is why this year is a very big year for gold, because the Fed has turned direction. Now, it's not just the Fed that is lowering interest rates. It's all countries now lowering interest rates. ECB, Bank of Japan, China, Bank of England, the United States, all central banks are now in QE mode. You say, wait, the Fed isn't doing QE. Well, they kind of are. They're providing liquidity in the form of the repo. So now you have all central banks. None of them are trying to, quote, normalize rates. None of them are talking about raising interest rates. They're all talking about lowering interest rates or coming up with schemes on how to print more money to buy more assets. The Fed is going to announce probably mid next year, early next year, a plan that if they don't want to use the tool of lower interest rates, because I don't think the Fed wants to go to negative rates, how they can buy a greater amount of assets than they bought during QEs 1, 2, and 3. And also, can they buy other assets? Now, they're not allowed to buy other assets, but I would imagine, given that the Swiss National Bank, the Japanese bank, they buy ETFs, they buy stocks, the ECB buys corporate bonds. The Fed doesn't buy that stuff. But I think the Fed wants to buy that stuff, and they think, what's the problem? Other central banks do it. Why can't we? We hear Trump say, hey, other banks are at negative interest rates. Why can't we get some of that money? Germany, why do we have to pay? So I think that the idea is that all central banks have finally thrown the towel in and realized, yeah, we tried. We can't unwind the QE. It's not going to happen. So we're going to try whatever we can. We're going to go negative interest rates. We're going to go zero interest rates. But mainly, I think they're just going to print the money, as Mario Draghi would say, and buy whatever they can to push asset prices higher. Now, that might push asset prices higher, but it is going to dilute the value of the currencies, and that's where your gold and silver rally comes in. So, this year, let's take a look at what happened this year in gold. Now, I've added in the far right today's action, got us over $1,500. The year opened up at $1,260. That is a big gain, close to 20% gain in the price of gold. Most of it happening when? In the middle of the year. Why? The Fed reversed course. Remember, the beginning of the year, the Fed was talking about how many interest rates they might do this year. Well, they did 3 cuts. That is a huge difference. And they're not going to be reversing course anytime soon, especially since the way they measure the economy, they've got the economy pretty much where they want it. They don't have their inflation where they want it. They think that the recession is probably going to come unless they continue to monitor things and react accordingly, which means perhaps lowering interest rates again. So there doesn't really seem to be any change in the direction now of interest rates. Well, if interest rates are going down and corporate bonds and globally there's, I think, 28%, 30% of all bonds are negative yielding, that is the best argument you can make for gold. So that's what really drove the price of gold this year, is that it is an asset that maybe the total supply grows 3 or 4% a year, but nowhere near the percentage that they add to the monetary supply. And of course, with negative interest rates, the fact that gold doesn't pay a rate of interest, at least unless you're lending it out, but just if you have it sitting in a vault, doesn't pay anything. That's still better than getting and paying to have a bank hold your money, which is not even, they're not even holding physical cash on a one-to-one basis. You have a claim check on a paper asset that they may not even be able to provide to you digitally because their balance sheet doesn't work. So that's what I think drove the gold price this year, and that's why I said, yes, maybe the rally is over for the year, but we'll probably have the Santa Claus rally, which it looks like we're having now. Let's look at what happened to price today, because the fundamentals for the price of gold and silver are still there. This is just trading. Now, the other thing that happened this year, here's the gold price today. You can see it rose another $12, $13. It's about where it is right now. Was all this talk about China? That was short-term trading swings, because what happened during the year was the price would go up and go down based on whether there was going to be a deal with China or wasn't going to be a deal with China. If there was going to be a deal with China, then the price of gold would go lower. If there wasn't going to be a deal that was uncertain, then the price would go higher. None of that has any impact, I think, long-term on the price of gold. It has no real impact on what the Fed's going to do, no real impact what the ECB is going to do, no real impact on what any central bank is going to do, maybe other than China. But all China's ever going to do under their current model is just print money and have the state-owned banks lend money to state-owned enterprises to produce goods and services that maybe they don't need in order to produce jobs and GDP. So that's not going to stop no matter what the deal is. In fact, if they do get a deal, they're going to need, instead of to subsidize, which they've been doing by printing yuan, the state-owned enterprises to keep them afloat, they'll subsidize them to produce more if there's a new deal with the United States. So that's not going to change, and I think that dynamic is what's going to drive the gold and silver higher. Now let's switch over to silver, and silver is following exactly as I had thought. Remember, I always said that silver doesn't go first, that silver is not primarily a monetary metal, and that it's going to trade as a commodity unless its dormant monetary component gets ignited. And that only happens, or has only happened, a couple of times since 1974. And the reason I use 1974 is that's the first year that both gold and silver traded on an apples-to-apples basis, meaning they had both gone through periods of demonetization. They took gold out of the coins in 1933. They took silver out of the coins in 1965. They got rid of the silver certificates in 1968. They got rid of the Bretton Woods Agreement, the global gold standard, in 1971. You couldn't buy gold as an American between 1933 and 1974. But by 1974, both gold and silver people could buy in the United States, and then they introduced the COMEX contracts. So they essentially could trade side by side, but gold held on to a monetary component because about 20-30% of gold is held by central banks, and they, under Basel III, banks can hold it. Banks could always have held gold on their balance sheets, and silver has not been held on central banks' balance sheets. It's not held by commercial banks. It is not held in general as a financial asset to the extent that gold is. 40% of gold demand each year is primarily just for investment, and another 40-45% is for jewelry, which arguably a good percentage of that, other than costume jewelry, is for investment, may serve a dual purpose. So 85-90% of gold demand is investment / monetary. It has a monetary component, and that's different than silver. Silver's monetary component, the amount of money that's invested in silver whether it's in India or the United States or anywhere, or EU, is only about 10-15%. The bulk of silver goes to satisfy industry. In fact, Chinese buy less physical silver as an investment, total, not per capita, than people in the United States. So silver is not held as widely, is not held in as much dollar amount as gold is. However, it still maintains an investable percentage. And when gold rises, and I say when gold has a sustained bull market, that's when people start to look at silver. In between, they don't. If you are in either a bear market or a muddling market where the price of gold is going nowhere, silver's generally going to be going lower, unless there's some special commodity reason for silver to be going higher. And in the past few years, there hasn't been, because the amount of silver used for electronics the past 10 years has actually declined. And the amount of silver used for solar has only gone up in single-digit percentages because they've learned how to thrift the silver. And it's the same with electronics. So silver has not had a surge in demand and has not had the types of declines in production that people are ranting and raving about. The silver's running out. It's not the case. So silver does not have a commodity. It's not like palladium where there's an actual shortage and then the palladium goes sky high. That hasn't happened to silver on the commodity side. And on the investment side, there isn't the same level of interest from investment houses, from central banks, and from general investors in silver. However, when gold hits a sustained bull market, you do see the price of silver rise because it's a smaller market. It then starts to look undervalued compared to gold. And right now, that gold-silver ratio is about 85-90 to 1, which I've been saying for 5 or 6 years would be the case unless gold really started to rise. And if you remember at the beginning of the year, at the end of last year, I said that I thought that gold would get to 1,500, 1,600. If that happened, silver would get to 20. Now, we didn't quite get there on silver, but we got there on gold. But the thesis is intact that if gold hits a sustained bull market, then silver will follow. And it looks like gold is just about in a sustained bull market. It's crossed over that 1,375 mark. It's moved forward to 1,400, 1,450, got all the way up to 1,550, fell back to 1,475, back to 1,500. If it continues to climb, we may see those numbers, the 1,600, 1,550, 1,600 in January, and then I think that's when silver will really start to catch up. Now, silver played along with gold this year, but it's lagged for the last 5 years, 6 years, 7 years, and it played along, meaning it also was up about 20%. But if gold goes up another 20%, chances are silver will go up much more. This was the first year where gold actually had a sustained rally that it drove through. That's 1375. And again, if we continue to have the Fed lowering rates, doing this repo, increasing the repo, that I think is a very positive sign, both for the gold and silver markets, also for the crypto markets, also for even the equity markets, and even potentially for the dollar if the Fed decides it's not going to continue to lower rates, or maybe does another rate cut or two, but actually decides to buy assets. Now, why would that be good? Well, if they're going to buy assets, what assets do you think they're going to buy? U.S. stocks, if they're allowed to. Now, they're going to have to go to Congress. But I think that's something that Trump would go for. I don't think he'd veto a bill like that. I think some Republicans would be totally opposed to that. But for the most part, most politicians, if the stock market's falling down, they don't say, well, yeah, that's a great thing. Let's have a financial collapse. They'll say, yeah, printed the money. But we'll see what happens. They may just do more QE in the form that they're not doing it now, and they may buy the longer-term treasuries. Who knows? And maybe there might not be what they consider to be a financial emergency where they have to buy anything next year. But they're certainly, I don't think, are going to be boosting interest rates. And if they did, that would change the whole dynamic. All right. Well, let's see. Also, by the way, I want to wish everyone who I didn't get to wish a Merry Christmas now. If you didn't celebrate Christmas, I hope you had a good day off. If you celebrate Kwanzaa or Hanukkah or whatever you do on your day off, I hope you enjoyed that. And let me just show you a couple of pictures here. I took this picture. I think this is a very nice picture. This is almost looks like a portrait, but it isn't. That is a live shot of my dog there. You can see behind the candles on the table and a figurine that my wife made, a donkey there. Not quite, I wouldn't say it's Christmas, but it is festive. So hope you enjoy that picture. And then I'll just show you a couple other pictures and we'll see what you guys are saying. There's the snowman. He's got his gold and silver in there. And here is a Christmas tree. Look at that. Looks like one of those. It's actually a Christmas tree made out of, looks like snowflakes. I think it's a very attractive design there as well. All right, well, let's see what you guys are thinking out there tonight. And there's your fundraising page. You know what to do there if you've enjoyed this or any of the other Smaulgld podcasts. All right. And says, here we are and the rally is on. Yeah, I as I mentioned, I think all of it all follows the interest rates. It all follows the Fed. If you really think about what's happened in that chart the last 10 years, it's all self-explanatory. Even though the Fed may have not been raising interest rates, the fact that they were talking about it for 3 years actually put a lid on everything. And going into 2019, we were stalled as well because it looked like the Fed was still talking about raising interest rates, normalizing rates. But if you look at when they changed, this year they said, nope, all of a sudden they're lowering interest rates. They did 3 rate cuts. I don't think they're going to reverse that next year, and none of the other central banks appear even willing to do that. ECB's already said it's going to continue through 2020, buying assets, lowering interest rates. China's going to continue. All the central banks are going to continue. Japan. All right, Max Strong is here. Greetings. Tom Manley, Gold Day. James Walker said, did we pass 2K yet? Not yet. Alan Gold, here comes Lewis the loser, bash away. To bash away. See, this is what people who watch the channel, when they hear objective analysis about gold and silver, if they don't hear gold and silver set to skyrocket, they think bash, or they start saying he's shilling for the whoever. And I know most of the people listening to this channel understand that if I say something negative about gold or silver, it's generally with a factual basis. When they try to say, yeah, but solar panels and electronics, we could not lead our lives without silver, that's just stupid talk. Yeah, you can't lead your life without copper either. You can't lead, but that doesn't mean the price of these commodities have to skyrocket just because silver's in yoga pants, and they are finding more uses for it every day. Or central banks are buying gold. That is all I need to know. Well, the fact is you need to know more than just simple pumper stuff that you get from binge watching pumper videos. I like gold, I like silver, but I like to analyze why they may go up or why they may go down. In fact, I generally don't even talk about the direction where I think they're going. I talk about the rationale as to why they are where they are. I got comments the other day. I asked, why are Russia, and I already had the answer, but it was the title of the video, why are Russia and Kazakhstan slowing their gold purchases down? And a lot of people think, well, they're lying. They're just fudging the numbers because they don't want people to know that they're buying gold and silver hand over fist. That nonsense. But of course, they believe the same numbers when they say they're on the increase. The problem with the gold and silver mindset, or any mindset, real estate, whatever industry you're in, you somehow think that the world revolves around your one asset. And that the people, when they hear India buys gold or China buys gold, they think that every person in China wakes up in the morning looking to buy gold. And that the people who buy gold somehow are imbued with some special type of intelligence because they know what's coming. And that comes from binge watching YouTube videos about gold and silver that just repeat the same stuff over and over, and they think it's fact just because they hear it 100 times. And then they think if they hear something contrary that I'm bashing gold or silver. It's not the case. All right. Albert says the U.S. dollar will fall. That's my prediction for 2020. And that's been the prediction for years. And the dollar index is right now stronger than all the other currencies. The reason the dollar is stronger than the other currencies is because the other currencies have 2 disadvantages. One, they're debasing more than the United States is at the moment. And 2, they are not a reserve currency the way the U.S. dollar is. Other countries don't need to hold yen or yuan or any other. They don't hold them. They don't use them in transactions. They're not on the SWIFT. That's what people don't understand. Most of the debt in the world is denominated in dollars, which means if China issues a Chinese state-owned bank issues debt in dollars, that means they got to come up with the dollars to pay. Well, that's what most of the world does. They issue dollar-denominated debt. And if you're paying attention and you want to go off on the whole thing about the world is awash in debt, yeah, it's awash in dollar-denominated debt, which means all these countries, all these debtors have to come up with dollars. That's what underpins the strength of the dollar. Yes, it's debt-based, absolutely, but we live in a debt-based global economy, and the dollar is the centerpiece of it. I don't know why that's hard to understand. People just think the United States has so much debt. It is unsustainable. Yeah, it is, but the whole system is. But the whole system revolves around the dollar. It's the other currencies that get whacked first before the whole thing implodes, and the whole thing may not implode. Who knows? But the idea that the dollar is the weakest currency because all the United States does is print is foolish, because all the other countries do is print, but they don't have the ability in many instances to print in the same way the United States does, because they don't have the demand for their currencies that the U.S. has for its. Okay. Powell wants persistent inflation before hiking rates. That is true, Albert. Trade and budget deficits skyrocketing. That is true. QE4. Yes, Albert, but it's all relative. If the other countries are also doing QE, if the other countries have trade and budget deficits, if the other countries are having zero or negative interest rates, on a relative basis, if the ECB has negative interest rates and the U.S. pays 2.5%, the dollar is more valuable on a relative basis than the euro is, which would mean if the euro is 60% of the dollar index, why would the euro appreciate against the dollar when if to order to hold euros, you get a negative rate, and if you hold dollars, you get a positive rate of interest? And you don't have the same demand for euros for debt. That's why the dollar index is strong. Everyone just looks at the flaws of the dollar. They don't look at the whole picture. Everything is relative in economics. Everything is relative. The dollar index itself is a relative index. You can't say, well, the dollar is weak. Weak against what? Weak against the euro? No, it's not. Weak against the yen? Think about what the Bank of Japan does. The Bank of Japan buys 60% of the country's ETFs. They just printed the money. Same with the ECB. Their QE right now is $1 trillion larger than the total of all the Fed's QEs. I guess if you just want to look at it from the point of view, you don't like the dollar and you like gold, and you think that that's all you need to know, well, then go listen to another channel that tells you that 100 times. All right, let's see what else we got here. Repo deets nuts. Okay. Artyom Inquisitive Minds. Merry Christmas. You're the most cynically bullish person that I follow related to silver and gold. Happy New Year to you. Yeah, I don't know what that means. There's a comment here that's funny, but I can't read it. But it's been hit by Lord Humongous. Yep, and Lord Humongous said debt-based systems suck. Yeah, but here's the thing. Coming online every night and telling you how much something sucks, I don't know what good that's going to do you. If the system is debt-based, then you live and you trade within a debt-based system. You earn your salary in a debt-based system. The idea that you may go and take your debt-based money and buy gold or silver with it doesn't change the fact that you still are valuing your gold and silver based on the dollar, which is a debt-based currency. And the dollar strength is based relative to other debt-based currencies. See, in the old days, there used to be a place to go to. So if the Hungarian forint or whatever country, German Deutschmark went under, other countries had sounder currencies. There is no sound currency. That is the argument for gold and silver. They are sound in the sense that you can't print them at will. The problem with gold and silver and why they haven't, quote, skyrocketed is they cannot be used. I don't care what you do, Texas Depository and gold money, Visa card. People do not use them as a medium of exchange. That's okay. It doesn't have to be used as a medium of exchange, but that does take away some of its value because there is some value in having a currency that is transactional, is universally accepted. Remember, if you go through your definition of money, one of them is widely accepted, acts as a medium of exchange, unit of account. Gold and silver do not act as a unit of account. It could be, but they're not. You cannot walk into stores and use gold and silver as a medium of exchange. That means they could be money, but they're not money. They're dormant money. But the chances, even in a financial crisis, in today's digital world, of people going back to using silver and gold, it's pretty remote. The only way they would go back to using silver and gold is if there was some type of event, EMP event, where you could not actually use digital. So, for example, if something happened where cars didn't work, we would use horses. But that wouldn't be the permanent solution. Say, well, it's better now. We got rid of those cars. They'd only do that once until they can get the cars running again. So it's the same with gold and silver. And that just means that gold and silver are insurance, but they're not long-term solutions for currency. They could be long-term solutions for asset wealth protection. But the idea you're going to walk around with a bag of silver dimes and buy your stuff and then... It's stupidity. If you think about how the economy works, who's going to accept them? Who's going to mint the dime? They're not going to mint, so you're going to be stuck with the current amount that you have. It's just, think it through. It's not going to happen. All right. Nick Rodriguez, the system will implode together. Agree. So once the dollar blows, the central banking nightmare is over. Yeah, but the thing is, no country, including China, including Russia, maybe not Russia, wants the dollar to implode. They all have a vested interest in not ever having to pay the piper. And because of that, that's why we've gotten along so far. That's why we've gone this far down the road. When the Fed finished QE, Japan started, ECB started. They're all doing it. They're all thinking about normalizing negative interest rates. They're all thinking about normalizing monetizing debt. They're all thinking about buying more assets. They're trying to make that seem like, yeah, if we got a problem, next time we got a financial problem, we'll just take rates down to -1 and we'll just buy half the country's ETFs. How's that sound? Yeah, that's fine. Yeah. Well, we might want to buy 60% of the ETFs and maybe we want to buy half the corporate bonds. Okay, you do that. And maybe we'll buy other countries' debt. We only bought U.S. Treasuries. Maybe we should buy some bonds from other countries. That's what they're doing. They're doing everything they can to just keep pushing the debt out further and further and further. But just to focus on the U.S. and say the United States debt is unsustainable and therefore the dollar is going to collapse and gold and silver are going to skyrocket is marginal stupidity, actually. Because it's a lot more complicated than just in fact, the dollar is the strongest currency in the whole fiat-based, debt-based system. So if you think the dollar is going to go first because of its debt, then you obviously don't know what's going on in the rest of the world, because the rest of the world is awash in debt, and it's awash in debt that's denominated in dollars. All right, I need to see what else we got here. Well, Albert's making a good point. Japan is doing so well. Look at the Nikkei. I never thought it would be possible. But it's all... That's actually an argument for them to continue doing what they're doing. Just print the money. Just keep printing. Have the central bank take over the economy. Have central bank take over the stock market. Have central bank take over the debt market. Have the central banks just do whatever they can. Ignore normal financial reality. That's the problem with Austrian economics. Austrian economics explains how economics works without government market intervention. But the problem is markets operate subject to or under the control of all of these governmental and banker interferences. And that's what's hard for people to understand. Say, well, when the free market takes over, what free market? All the markets that you're talking about, the COMEX, the New York Stock Exchange, and NASDAQ, they're all regulated, controlled markets, the Nikkei, and they're all controlled by either governmental entities, quasi-governmental entities. The same in China. All the banking is done through the People's Bank of China, through the state-owned banks of China who lend to state-owned enterprises. That's not a free market. It's all controlled. So the idea, Austrian economics makes perfect sense if there's no government intervention. It shows how supply and demand work. It shows how malinvestments get liquidated. But we know malinvestments don't get liquidated. They get bought by central banks. So when people talk about this stuff, it's almost how they wish it to be rather than actually how it is. And that's how I look at things. All right. I want to thank everyone for listening. And we will see you all soon. And if I don't see you before New Year, well, I'm not going to see any of you probably. Oh, wait, hold on. Got another question here. I was going to wish you a Happy New Year, so I'll do that now. But let's see. Harvey Greensman. I wonder who that is. What's up, Smaulgld? Going to pick up a $10 Liberty and 11 Morgans. Where are you going to pick those up? If you're going to buy, here's a pitch. If you're going to buy gold or silver, I'm not advising that you do so, but you can do so through the Smaulgld affiliate links, and I will get a small commission. It is a way to help keep the channel going if you like this type of analysis. Some people don't. They just want to hear central banks are bad. Central banks are buying gold. I love that. Central banks are bad, but central banks are buying gold, and that is all I need to know. So I'm going to buy gold. But if you are going to buy, you can buy through those links, and Smaulgld will get a small commission. We have affiliate links with SD Bullion, Money Metals Exchange, Golden Eagle Coin. Click on those links. I get a per transaction. It's not how much you spend. I just get a per transaction small fee. I think it's like $15, $20, but it does help. So if you're not going to donate or become a Smaulgld patron or a Smaulgld subscribe to our member or send cryptocurrencies or items of value in the mail to me, then you can always buy through the Smaulgld links. I do appreciate that. Money is mine, not printed, says Lord. Federal Reserve note, I owe you nothing. That's true. Lord among us, that's what they are. They can print them as many as they want. The problem is people actually believe they have value, and you get paid in them, and you pay your rent in them, and you buy gas with them, and they actually, nothing becomes something. William Birkenrod, exactly. We were wishing markets were free without ever banning the free market, laissez-faire global economy. Well, the closest we had to a laissez-faire global economy, they say, is in the late 1800s or before the Federal Reserve, in between the two central banks of the United States. They claim that they were, when the gold standard was the real gold standard. Briefly, the gold standard we had in 1944 to 1971 was not a gold standard. That was a dollar standard. All that said was that the United States was the biggest and baddest country in the world, and you had to have dollars, and the dollar was backed by gold. If you were a central bank, and if you wanted to bring your dollars that you accumulated in trade, which you wouldn't because you'd have a negative trade deficit with the U.S., you'd never have a lot of dollars because the United States was going to be the biggest and the baddest country forever. Well, what happened in the 50s, when Europe started trading with the U.S. and started getting bigger, they started accumulating trade surpluses with the U.S., which meant they got more dollars, and they were allowed to go and bring those dollars to the U.S. for $35 an ounce, which was the price set by the U.S. Congress in 1934. They could still get their gold for $35 an ounce from the U.S. Treasury. All they had to do was just tug the boat, the warship, into the harbor and hand the dollars over and get gold. Nixon said enough of that, gave that up in 1971. That is not a gold standard. A classical gold standard, which happened in the late 19th century, early 20th century, was one where every country that was part of the agreement, would measure their currency based on a unit of gold. And then as the trade surpluses went back and forth, the country had a surplus would have more gold, and then you were wealthy if you had gold, and then it would reverse itself. If you had a trade deficit, you'd have to give up the gold. That's a real gold standard, and that's somewhat of a free market standard, using the gold standard not to manipulate the market, but just to be reflective of the positioning of the different countries. But the Bretton Woods agreements in 1944 was a hybrid, was a mismatch. They actually had wanted to do something like an SDR. I forgot the name of it. They had some name for global currency. I can't think of the name. Anyway, it was some Keynesian. It was actual Keynes, not Keynesian. It was Lord Keynes wanted to introduce that, and they didn't go for it. All right. Oh, that looks like it's it. So, Lord Humongous says Happy Hanukkah. Okay, Happy Hanukkah. Oh, we've got another 2 Happy Hanukkahs. Okay. All right. Well, we'll see you soon.